There are a lot of fake gurus out there which are scamming people for already published and free literature about trading, especially liquidity inducement trading and a smart money course or a smart money concepts trading. And I'm here to help you to access those already published information. I decided to go further with a more categorized manner. So this is episode 0 of free liquidity inducement course from Trading Companion. Hi, how are you? Mehran's here, your trading companion, and today we want to talk about liquidity and inducement trading, or LIT. I decided to continue to help you in this channel for free but more categorized. So here's the PowerPoint, and I'm going to make PowerPoints for the next videos. This is the episode 0 of liquidity inducement trading, and today we want to talk about why liquidity and inducement is real, why it is important, and how we can avoid getting liquidated. This channel is especially for those who want to avoid getting scammed by gurus, because liquidity inducement may be something different and something more powerful than other methods of trading, but it is not new. Most of its literature is public out there, and today we want to start this course. Yes, some advanced things about liquidity inducement trading or smart money trading is not published yet, but most of that is free out there. You can find them, and in this channel we want to make sure that you have access to most of those trading methodologies. In this channel we are going to talk about advanced technical analysis that's very fractal and very accurate. We are going to talk about smart money concepts and liquidity trading, and some psychology concepts as well that helps you to improve your mindset and to improve your business. Anyway, what is LIT, or what is liquidity and inducement? Liquidity is when you analyze the market right, but you take stop losses. I've had more than 1,000 students in my native language. I'm a good teacher in my mind and in their reviews. And the most important challenge that most of new traders are facing is that they can analyze the market very good and very accurately, but they can't enter the market, or they get out with stop losses, and then the market starts to move in their direction. But why is that? It's because of the big boys. We may enter the market in different prices, but our stop losses are almost every time in the same spots and prices. For example, we are going to put our stop losses below the last low or above the last high, or we are going to use some indicators or some tools like the pivots indicator or ATR stop loss indicator for putting our stop losses in the market. So we may enter with different methods, but our stop losses is going to be in the same places. Let's see how liquidity or liquidation of other traders work on a chart. It is volume colored candles. It just changed the color of the candle based on the volume in that candle. And high volume candles have many purposes, but here we are going to talk about one purpose of high volume candles. They act as good support and resistances like here, and they act as liquidity points. For example, here we have a high volume candle, this candle. What's important about this is that the activity of traders in this candle is very high. I don't care if they are big boys or big traders, or if they are small traders. They are going to get trapped by this movement, and you can see how the market is going to react to this liquidation. And the more important thing is that market is fractal. So for example, if this candle is in 1 hour, we can enter the market on 5 minutes for this movement, and this is a very good and very big movement in the 5 minutes. And if we go back, we can see that we have another high volume candle here, and you can see that when it gets liquidated, the market bounces up. And we have another point of liquidity here, and you can see that when they get liquidated, the market bounces up again. We go here, so I said that they act as support and resistances as well. For example, this candle gets broken and it acts as support and resistances. When I go back in the charts, you can see that we have a high volume candle here, and more importantly, we have another high volume candle above that candle, so it can be our POI. You can see that it liquidated this point, it touches this point, and it goes down. Let's see other examples. For example, here we have a high volume candle, and this is a high volume move, and it liquidated it and went upside. So the important thing is that liquidity works in the market, and big boys are searching for liquidities. For example, here we have another liquidity point as well. It is a smart money trap, and all those who are using ICT or smart money concepts or any kind of smart money concepts trading are going to get liquidated here, except us who are going to learn how liquidation of other players of the market works. So why this happens, why the cycle of liquidation and market movements are so tied up to each other that you can't be a good trader without knowing what is liquidity, or you will learn it by courses and books and good traders like here, or you will learn it by experience and being in the market or screen time. Because big boys, they have enormous sized positions. For example, investing banks, brokers, prime brokers, and big traders, hedge funds, all those big players, they don't have one lot of trade, or they don't have $1 million in trade. They have billions of dollars trade in these markets. For example, BlackRock have the money that is more than 5 good countries' GDP. So you can't say that BlackRock wants to, for example, purchase some euros, and he just goes and click the buy and their orders gets filled. They need opposite side orders, because they want to buy something, they should buy that from sellers, and if they want to sell something, they should sell to buyers. So let's see this concept in action. For example, right here we have a very strong bearish movement, and imagine that sellers and even institutions started to sell here, sell here, sell here, sell here. Where are they going to put their stop losses, even with a smart money concept? We can see that here we have an order block, it got liquidated with this movement, and this went the downside. All the traders in the world are going to use this high for their protective stop loss. Even if they are selling the market here, they sold the market here, or they sold the market here, they are going to put their trailing stop loss here, or they are going to cover their positions here, or some parts of their positions. And there are a lot of traders, so the traders that entered here or here are going to put their stop losses here. The traders that are breakout traders, they are going to put their entry here, and they're putting their stop losses here. They are going to buy the market because it is a breakout, and it is a good movement for breakouts. So who is selling to them? The big boys. A lot of traders who sold the market are going to put their stop losses, their trailing stop losses here. Who is covering their buys and who is selling to them? it's the institutions, because when you sell something and you are going to get out of this sell, it is a buy order. And who is selling to that buy order? It's the institutions. There are many traders that are going to get stopped out here, and then the institutions that sold to those buys are going to start this movement. You may think that I'm hallucinating, but it's the real thing, it's the real deal, and you can see that on charts. You get a stop loss says every time, and then the market is going to move in your direction. Let me explain how does it work. A lot of big institutions are going to just doing their clients' orders. For example, think that Australia want to import something from USA. They are going to buy a lot of US dollars and they are selling their Australian dollars. They go to some investing bank and they say that every price above, for example, 67,700 is good for us. And if you can fill our order in that price, we are okay. But if you can sell above that price, so we are going to buy the US dollar in lower prices, we are going to give you some commission. So they start to sell the market from here, and the market starts to move down when their sales get filled. And when the market is ready to move from this point to the downside. Why? Because the market needs fuel, and those selling orders are the fuel of the market. And the market just starts when this fuel is enough to move the market to the downside. So it is not how you think the market moves. Always the volume of sell to the volume of buying orders are the same. It's not that we have more selling volume. It's just the deal between the sellers and the buyers. So when a lot of traders are going to say that here or here, Australian versus US dollar is expensive, the market starts to go to the downside. How it gets the fuel to do that? The orders that get filled, not our one lot trades, the institutions trades. So how we can avoid getting liquidated with big boys? You should start to find liquidity pools or liquidity points on charts, and you should try to find where those points are, where other players are going to put their stop losses, and you wait until they get stopped out, and then you enter the market and you get, for example, continuation. Or a very simplistic view of the market, you are going to find out after a while that your stop loss placement is not good, so you should change your stop loss placement. For example, use a wider stop loss. Or you are a guru in the market, you have traded 100 years and you are okay with 20-30% win rates. These years you can find a strategy that, for example, have 70% win rates and for example gives you 3 to 1 reward to risk ratio or 4 to 1 reward to risk ratio, or even it's consistent, so you will experience some low win rate strategies. This is enough for today for this episode. I'm trying to talk less and make videos smaller and more short, but I'm a teacher and a teacher speaks a lot. Thank you for watching this video. We have some kind of semi-free material too that needs just a broker account, that a real account that's for real traders, active traders, and you can access that in the Telegram channel. I'm going to put our link below. You just should use our referral code. That doesn't change your commission, that doesn't change your spreads, that doesn't change anything in your account. that's just something that helps us to make more videos for you. Thank you for your watching. Your subscriber, like, and comments are going to help me a lot. If you have any kind of question, you can ask me in the comments, and you can be sure that I'm going to answer it.